please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Wall Street witnessed Monday blues as major indices slipped 1.5% and ended the day at 2-month closing lows. Broader indices saw a drop of almost 2% each. So over 80% of the Nifty fall was led by financials, with HDFC Bank, ICICI Bank being the top losers. Let's bring in Anuj Singhal as always with a wrap of the day's trade. Anuj, decode the Wall Street panic for us. Where does the panic start from over here?
Well, there are market cycles and there are market cycles. This is one of those cycles which is playing out. And frankly, it's classical case of market moving ahead of the curve. The market peaked out and moved from greed to fear in a matter of a month. It moved to a put-call ratio of 2 and we were worried that perhaps something is amiss here. Triggers always come later. The market senses it first, and the market did that. Now we are, of course, talking about crude, rupee, debt freeze. This market knew about it all along. And the best example of that is the way some of the large haloed stocks have fallen. Nothing is sacred in this market. Bajaj Finance is now corrected 25% from highs. Eicher Motors, HDFC, HDFC Bank are all down about 15% from the highs. Again, you know, the selling had started much before all these problems had surfaced. A lot of these stocks had started to see selling. So the market was always a step ahead of all of us and was giving you all these indications. Now the obvious question is, what next? Look, if you're a trader, this is a moving trade. We are in expiry week. The bears have all the momentum. 10,950 is just the last remaining support. My sense is it's a matter of when and not if it goes. 200-day moving average of 10,750 is likelihood. The market likely to panic at extreme or likely to bottom at extreme panic now. You could be looking at, say, a put-call ratio of 1 or 0.9 to 1. That's where historically it bottoms out. We're at 1.05 right now, which may coincide perhaps with this expiry. But things are looking rather weak right now.
Okay, fair enough, Anuj. Thanks for taking us through that. Anuj was talking about crude, so let's pull those up for you. Crude oil prices continue to surge very clearly at the back of tight supply. So Brent has crossed that $80 a barrel mark and is currently trading with more than 2% of gains. NYMEX is also trading at that 72.08 mark, up by about 1.8%. Commodities editor Manisha Gupta is here to decode this sharp crude uptake. The 90 mark inches closer, Manisha. Is 100 very close by as well?
Well, that is what some traders and banks really have reiterated. JP Morgan, for one, says that $90 is a possibility by end of this year or early 2019. On the other side, you have the oil merchants like Trafigura and Mercuria who are saying that $100 is a possibility by early 2019 as well. Well, the fundamentals, all of that are quite positive. To begin with, the meeting that happened in Algiers on Sunday, the Saudi Arabia and the Russian oil minister have very clearly said that they're not looking to increase oil output immediately. They would rather be compliant. Right now, they are 130% and they would want to come back to 100%. So they actually are talking about cutting output here. On the other side, it really is about Iran's sanctions and the market tightening ahead of that. We already are down 38% in sense of Iran exports. And the market believes that 1.5 to 2 million barrels per day could be knocked off by the market in the final quarter of this year. Again, a very, very strong fundamental there. And the U.S. inventories at 2015 lows is yet another reason that you have seen the crude oil prices running high. But having said that, there's a caveat. Many oil-consuming countries already have started cutting cutting imports rather. And then, of course, you have the currency play, the Fed meeting in this week as well. So those are some of the factors to just stay slightly realistic on crude oil prices. Having said that, it really seems like 80-85 could be a range to look forward to for the rest of this year.
At those levels, Manisha, it's going to be difficult to stay realistic. But thanks for taking us through that and decoding that analysis for us. But, as Manisha was saying, the 10th OPEC and non-OPEC meeting in Algiers wrapped up yesterday, where OPEC nations and Russia argued the basic demand-supply rationale when it came to measuring the output barometer. So listen in to what Saudi Arabia's oil minister and Russian energy minister have to say about OPEC's output target.
We're going to assess the market and where we are, and as we all know, we have achieved pretty much the objectives that we set out in 2016 to achieve. Markets are relatively balanced, supply and demand are in line, inventories are where we targeted them to be. And we're looking beyond the current agreement now to 2019.
First of all, let me say that we are acting within the framework which has been agreed on in June, and we are within that framework. So there have been no infringements, there have been no stepping out of this by Russia or by any other country. In fact, we're at 129% conformity, so we still have not reached 100. And this is something which all sides have agreed to in June. We're all jointly as a group exerting effort to be able to achieve a balanced market, which means acting both when there is deficit and when there is surplus in order to counter those trends.
Okay, so we are, of course, going to be tracking that closely all through the day. But let's get to the big story back home. Investors continue to sell NBFC stocks on fears of liquidity crisis gripping the sector. Bank Nifty closed with losses of almost 2.5% even after Finance Minister Arun Jaitley assured that the government will take measures to provide liquidity to NBFCs. So what lies ahead for the sector? Is there more pain in store? Let's go across to Lata Venkatesh to understand this further. Lata, what is your take? Should we panic further now?
Well, actually, the mutual funds whom we spoke to said that there were no big redemption calls. Of course, nobody will admit even if they have. But the chatter in the community is that it's not, it was a calm market today. Trades were not there, but usually this commercial paper and bonds are not traded. They are bought and held to maturity. So it's not unusual if trades don't happen. And obviously in the current atmosphere, if at all there are sellers, they want it at a higher yield, and there aren't enough buyers at lower yields. So what has happened is that if you for NBFC companies, they can raise money only at a higher cost. For some of them, probably the debt market will not take their paper at all, and they will have to go to banks, and banks obviously will charge them more. Maybe in course of time, the NBFCs will be able to sell some of their paper at a higher yield. But what they have to be definitely prepared for is a higher cost of funds, which perhaps they cannot immediately pass on. At the moment, it's not tumultuous in the bond markets. Yes, yields have risen because of crude and because of rupee, both crude rising and rupee falling. So yields have risen, and also because of lack of appetite for NBFC paper. So cost of money has gone up. There's otherwise no tumult. The important part is the way in which, look at the math that Credit Suisse has put out. They've pointed out that the share of non-bank sources for NBFCs over the past year has risen to 74%. So NBFCs raise only 26% of the money they need from banks. Now they have to shift because that source is drying up. MF exposure to banks itself, to NBFCs, has increased 3 times in the last 2 years. So mutual funds may also want to pull back. They've not reached any cap. The SEBI cap is 25% of total exposure. MFs are at 17% with respect to their exposure to NBFCs, but it is still higher than their exposure to other sectors. So they may curb. And that is why you are going to see a rise in the cost of money. Otherwise, there was calm in the debt markets with people coming to terms with the higher cost of money.
Okay, Lata, thanks for putting that into perspective. But, earlier in the day, we spoke to SBI Chairman Rajneesh Kumar, who says that panic with respect to NBFCs is unwarranted altogether. He also assured that SBI will continue to lend to NBFCs. Listen into what he had to say earlier.
We keep on watching the developments, but as of now, the NBFCs with which bank has relationship, and if there is any requirement or if they approach, then whatever we do in the normal course of our credit due diligence, and based on that, there is no problem. In fact, in yesterday's release, I have also mentioned about SBI's willingness to partner with NBFCs for co-lending model. This we have been planning for about a year now. And the concerns on NBFC because of IL&FS, I think there is a extreme reaction which is totally unwarranted.
Okay. Well, that was the SBI chairman saying that he has a headroom to lend to NBFCs, but the same Credit Suisse report I referred to says that bank exposure to NBFCs is 6%, which is apparently a little higher than the long-term average. So they expect banks also to be wary of increasing their exposure to this sector.
Okay, Lata, thanks for adding that important point. But let's talk about another important story that we've been tracking today. And speaking of panic sell-offs, the crisis at IL&FS continues to hurt investor sentiment. Shares of the group companies saw some respite in trade today after some senior executives announced their resignation over the weekend. But many questions surrounding IL&FS still remain very critically unanswered. Sonal Sachdev is here with more. Sonal, what's the perspective that we can look at while measuring IL&FS stock and the sell-off today?
Yeah, I mean, like you said, there are several questions that arise from what's been happening at IL&FS. You can call it the IL&FS a mess, if you will. The first is who's responsible for this mess. I mean, you have people in the management of the financial services arm resigning and going away, independent directors going away. Please note, Ramesh Bawa and Vibhav Kapoor, who are part of IL&FS Financial Services, also part of the management board of IL&FS. So they've gone. So you don't have the management you can speak to. You have board members, you have LIC, SBI, central bank representatives on the board. None of the people at these entities is willing to take responsibility or come out and share a plan of what lies ahead. Nor do you have anybody else from the government or whatever coming out and sharing a plan. So that's the first question. I mean, accountability. Who's responsible for this? So there are no clear answers there. The second big question is, given that IL&FS is effectively controlled by public sector enterprises, can you infer that the government is effectively the owner of IL&FS? LIC has 25%, SBI has about 6%. You put all these entities together, that's about 40%. There's about another 12% lying in the employee welfare fund. Assume that to be part of the block, so you clearly have majority there. As far as the board is concerned, 5 board seats with these enterprises, plus 2 executive positions, and independent directors, will be appointed or will have to be passed or cleared by the board, so effectively controlled there. Given that, how you would look at any private entity saying that, okay, beneficial ownership and who's effectively the owner of these entities, in this case, it's the government. So can you therefore say the government is responsible? And therein lies the catch, because you have proceedings that have been filed against IL&FS entities in the NCLT, so insolvency proceedings. So therefore, are you saying government by inference can be seen in default, or these entities can be seen in default? The third question. So is the issue about asset quality or just liquidity? We have management teams walking off. Is it because they smelt something there and don't want to be around, or have they been asked to go? There's no clear question. There have been stray statements. We also had the State Bank of India chairman talk about some assets of IL&FS being good, but people are saying some. Nobody is talking about the complete picture. Right. So is there an asset quality issue? If there is an asset quality issue, considering that LIC is the largest stakeholder there, it calls into question the governance or the capability or bandwidth that LIC has to be able to manage so many entities. And we know LIC is up to take over IDBI Bank. It raises questions around that. The last question. Is accountability a reason for RBI to review the cap on promoter stake? We know right now, banks, there's a cap on promoter holding. Now, with a low promoter holding, diversified holding, it's difficult to hold somebody, any one person accountable. So will RBI take this cue and review that? Maybe if you have more majority, there's more skin in the game, you have somebody you can hold accountable.
Okay, it's a heady cocktail of questions, Sonal. Thanks for that. Amidst all of this, Japan's Oryx also perhaps reportedly looking at majority stake. A lot of questions there. We'll, of course, be tracking this story through the week. But for now, let's talk about the big global story today. The trade war between the US and China has entered a new phase, with both countries going ahead with the imposition of new round of tariffs on each other's goods. While US is targeting Chinese imports worth $200 billion, China has hit back with tariffs on American goods worth $60 billion. China has also accused the US of engaging in trade bullyism and intimidating other countries to submit to its will through such measures. Now, let's at that point look at what global markets have reacted to the latest developments in the tariff war markets in US and Hong Kong, which were open for late trade today, ended the day in the red. So Europe is no different as well. That's Asian markets for you. Hang Seng down by about 1.6%. European markets seem to be in the red. So FTSE is holding fairly strong, but DAC down by about 0.3%. French CAC also down by about 0.2%. On to an exclusive story. We told you first on the 12th of August that cash-strapped Jet Airways was looking at selling stake in Jet Privilege, the frequent flyer loyalty program subsidiary, in a bid to shore up funds. Now we learned that TPG Capital and Blackstone have already submitted their financial bids. Two more suitors, Indigo Partners and Singapore's GIC, could be submitting their bids later this week. So what's on the table for Jet Airways? TPG and Blackstone, we learn, have submitted bids between $350 million to $400 million for the airline's 49% stake in Jet Privilege. The offers have fallen short of Jet Airways' expectations. Remember, global consulting firm On Point had valued Jet Privilege at $1.13 billion just earlier this year and ranked it at the 31st position amongst world's top frequent flyer programs. It is based on this report and the due diligence conducted by its investment bankers that Jet was expecting at least $500 million to $572 million for their stake. That's not all. We also understand that Jet may retain a minority stake in the program. We, of course, reached out to all the players in this story, but no one has responded to our query yet. Staying with aviation industry, passenger data for the month of August is out, and it shows that domestic traffic grew at a speed of 17% during this month. It had lower compared to 20% growth clocked in July. While Indigo saw a marginal decline in its market share, Air India, Jet Airways and SpiceJet witnessed modest increase in their share of the pie. In fact, Jet Airways at 13.8% is quite healthy versus what we're seeing of Go Air and SpiceJet. Now, the Information Technology Ministry has made it clear that they're not in a position to ask the RBI to extend a deadline for payment companies to comply with the data localization norm. What exactly is the plan at this point in time? Ashmit Kumar has been tracking that story. Ashmit, what are you picking up from your sources?
Well, just to begin with some benefit of the context for our viewers, in April of this year, the RBI had come out with a circular whereby they had made it clear that all payment companies, and when we say payment companies, we mean companies like WhatsApp Pay, such as Amazon Pay, Visa, MasterCard, all these payment companies will have to store data of Indian users locally here on Indian servers, as that would allow regulatory access to the RBI. Now, that circular had come out. The deadline for that was October 15th. Now, given that the deadline is only a few days away now, there has been heightened tensions among payment companies. All of them have been making submissions to various government players to seek an extension as far as this deadline is concerned. However, we spoke to highly placed sources within the Ministry of IT, METI, and what we've learned from our sources is that METI has its position quite clearly spelled out. That this is a provision that was brought into force by the RBI, that the METI, as far as this entire proposal is concerned, has absolutely no role to play, that it cannot make submissions on behalf of payment companies to the RBI, that the decision on whether or not to extend this deadline is solely that of the RBI, and given that it's an independent regulator, METI will not be intervening, cannot be seen taking a side as far as this entire issue is concerned, and that the payment companies would be better advised to approach the RBI. Back to you.
Okay, Ashmit, thanks for taking us through those details. Here's the big exclusive from Yes Bank now. After the RBI curtailed the tenure of Yes Bank's current MD and CEO, Rana Kapoor, to the 31st of January 2019, we learned that the hunt for the new chief executive officer will be the top focus for the bank's board meet tomorrow. But that's not the only focus. Ritu Singh is here with exclusive details. Ritu, who are the possible candidates and what will be Rana Kapoor's role post the 31st of January?
Well, those are exactly the two things that will be key on the agenda as the board meets tomorrow. It is a critical meeting. One, of course, is finding a successor to Rana Kapoor. Now, the strong internal candidates that are seen in the fray include the likes of Rajat Monga and Pralay Mondal. It is likely that the bank will set up an independent search committee and rope in an external advisor as well to go through this process and finally submit the name to RBI for their approval. Interestingly, after the 2015 June, Bombay High Court verdict, which was the legal tangle between Rana Kapoor and Madhu Kapoor, the wife of the late founder Ashok Kapoor. Now, both of them have rights to nominate the CEO member to the bank. Will they or will they not exercise that right? Because they are warring promoters, they may or may not agree on a single name. That remains to be seen. But the other bigger question is the role of Rana Kapoor himself in the bank. Remember, right now, by virtue of being the MD and CEO of the bank, he also serves as whole-time director. But, given that he has to relinquish that position, the legal opinion is that he also therefore gives up his position on the board. Now, there is a clause in the Articles of Association of Yes Bank that says that as an Indian partner whole-time director, he's not liable to retire by rotation. But at the same time, there is the Banking Regulation Act, which says, if a whole-time director is removed, which he will be if he steps down as MD and CEO, he's also not liable to be director on the board of a company anymore. So how do the two play out? Really, that remains to be seen. And, the wider opinion among the industry is that this may end up in the courtroom.
Oh, well, it's going to be an interesting battle then. And of course, tomorrow is the board meeting. Ritu Singh is going to be tracking that, and we'll have her back for the updates tomorrow morning. But for now, we will have to wrap up this edition of After the Bell. Many thanks for watching the show. Stay tuned. Markets Today, Fear Factor is up next.